What's up, guys? It is Ryan, and today I want to talk about what happens when you not only get approved for a mortgage, but then you settle on a mortgage. What happens to your credit score? Because many people ask me, I just had a guy yesterday, he called me, he said his score dropped 60 points. Let me explain what happens in this whole time frame from the time before settlement till the time after settlement. Obviously, you're going to have, let's just say over here, an inquiry, okay? INQ. That inquiry is going to cause your score to drop, let's just say a little bit. Okay, 5 points in most common situations. If you look it up, you'll see a common inquiry is going to cost you 5 points. It's not a big deal. What else might also lower your score? Once you get this new mortgage, you're going to have a new account, and that new account is going to also lower your age of history. This is why your score may drop, because all these things are showing new accounts, new activity. Any new activity is typically going to lower your score unless you're adding a credit card, in which case you get added credit limit. In this situation, you're adding a new account, new age of history. It's going to cause your score to drop a little bit. It should not drop 60 points. What could cause your score to drop an additional 60 points? If you do open up a new credit card. If you do have a credit card and max it out. These two things could cause your score to drop even lower. But that's not common. As far as the mortgage goes, the first month, you get a new account, new age of history. It's going to lower your score for the first month. That's going to stay this way for 3 months. On the fourth month, here's what happens. Those 3 months of you paying on time is now going to report and say you have paid a new account on time for the first 3 months, and poof, new score. So it's not a big deal if your score drops once you get approved for a mortgage. It is a big deal if you're not watching your credit card utilization, because if you max out your credit card utilization, that could cause your score to drop as much as 100 points. And I've seen that happen many a times, especially if you have lower limits. This is why you want to build them up. But as far as the mortgage goes, once you have this new mortgage account, this adds to your account diversification. The more you pay on time, you're going to add to the age of history. That's account diversification and account depth. The good thing about the mortgage is it's 30 years. Even though the average person neither sells or refinances within 7 to 10, it's a 30-year account that's going to continue to pay on time. The more you pay, the more the score is going to continue to increase. This is why it's really important for you to understand all the different types of accounts that you have in your portfolio, because your credit portfolio is made up of, again, mortgages, personal loans, auto loans, student loans, credit cards. All these different accounts have different impacts. Mortgages have a big impact, and that's why you may see a relatively big drop at first, but don't sweat it, guys. Keep paying that mortgage on time. Keep all your balances low on everything else, or your credit cards paid off to zero, and then you will eventually see that score go right back up. In fact, it will go up higher than where it was before when you got your initial inquiry here, because adding a mortgage account is a heavy weighted account on your credit profile. Hope you guys found that helpful. If you have any questions, put them below. If you liked it, give it a thumbs up. Make sure you share it, spread the love so that we can all continue to learn. If you want to learn more for yourself, if you're trying to get approved for a mortgage, or you have questions with regards to your credit, let me know. I'd love to help you guys. Give us a call, and we'll catch up with you later.